In 1998, a fund called LTCM came close to breaking the global financial system. The portfolio looked diversified on paper. It held positions across bonds, equities, and derivatives in many countries. Then one regime shift hit. A regime shift is when the market rules change fast, correlations jump, and yesterday's safe trade becomes today's crowded exit. Russia defaulted, spreads blew out, and suddenly everything moved together. Correlation is how much two assets move in the same direction. When correlation goes toward one, diversification stops working right when you need it most. That case is why I start with a hard question. What is diversification really buying you, and what is it not? Most people hear diversification and think it means owning a lot of stuff. More tickers, more funds, more lines in a portfolio. That is not the point. The real benefit is not variety. The real benefit is controlling the distribution of outcomes. Distribution of outcomes means the range of possible results, including the ugly tail. Tail risk is the chance of extreme losses that happen rarely but matter a lot. Diversification is a tool to reduce the chance that one surprise dominates your financial life. I want to keep it grounded. If I own one stock, I am taking idiosyncratic risk. Idiosyncratic risk is risk unique to that company, like fraud, a product failure, a lawsuit, or a CEO mistake. Diversification across many companies can reduce that risk because those events are not perfectly correlated. If one firm blows up, the others might be fine. That is a real benefit and is one of the few free lunches in finance with a big asterisk. The asterisk is that you never diversify away market risk. Market risk is the risk that the whole system reprices, like 2008 or March 2020. In those moments, the tide goes out and most boats drop together. So why diversify at all if the big crashes still hit? Because survival is the first job. If I can reduce the chance of a catastrophic drawdown, I stay in the game long enough for compounding to work. Drawdown is the peak to trough decline in my account. It is not just a number, it is a psychological event. A 50% drawdown needs a 100% gain to get back to even. That math creates bad decisions. People sell at the bottom, they chase at the top. They abandon a good process because the pain is too loud. Diversification is partly a behavioral tool. It reduces the odds that I panic at the worst time. Warren Buffett is often used as the argument against diversification. He has said that diversification can be protection against ignorance. I get the point. If I truly understand a business, if I can value it with a margin of safety, if I can hold through volatility, concentration can increase expected value. Expected value is the average outcome if I could repeat the decision many times. But most investors are not Buffett. Even Buffett diversified in his own way. Berkshire owns many operating businesses, and it holds a wide set of public equities, and it keeps liquidity. Liquidity is the ability to raise cash without taking a huge loss. That matters more than people think. Charlie Munger also leaned toward concentration, but he was ruthless about the quality of the few bets. That is the part people skip. They copy the concentration, not the standard. They end up with a small basket of fragile ideas, and then they call it conviction. Conviction is not a risk control. Process is a risk control. Now I want to talk about the most common misunderstanding. People think diversification means lower returns. That can be true if you diversify into low expected value assets. But diversification done correctly is not about adding random stuff. It is about combining return streams that do not fail at the same time. A return stream is just a pattern of gains and losses over time. When you combine streams with low correlation, you can reduce volatility. Volatility is how much returns swing around, up and down. Lower volatility can let you take more exposure safely, or it can let you sleep and stick to the plan. Either way, it can improve outcomes. This is why Ray Dalio popularized the idea of risk parity. Risk parity is a portfolio approach that tries to balance risk contributions, not dollars, across assets. The concept is useful, even if you never run that exact model. If bonds are less volatile than stocks, a dollar in bonds does not carry the same risk as a dollar in stocks. Many people think 60-40 is balanced because it is 60% stocks, 40% bonds. It is not balanced by risk. It is mostly equity risk. In a normal environment, bonds diversify stocks because growth scares and inflation scares alternate. But again, there is an asterisk. In 2022, stocks and bonds fell together. Inflation was the common driver, and correlation rose. That is the LTCM lesson in a different costume. So I treat diversification as conditional. It works differently in different regimes. A regime is a market environment defined by growth, inflation, policy, and liquidity. If I build a portfolio assuming bonds always hedge stocks, I am making a bet on a regime. That is not diversification. That is hidden concentration. Hidden concentration is when many positions depend on the same underlying factor, like low rates, cheap funding, or stable volatility. Let me bring in a trading example. Paul Tudor Jones is known for focusing on risk first. He has talked publicly about cutting losses and managing exposure. Traders like him and Stanley Druckenmiller think in terms of position sizing. Position sizing is how big a bet is relative to capital. Diversification and position sizing are cousins. If I have 10 positions, but one is 5 times larger than the rest, I am not diversified. I am concentrated with decorations. This is also where leverage becomes dangerous. Leverage is borrowing or using derivatives to control more exposure than my cash. Leverage magnifies both gains and losses. It also creates path dependency. Path dependency means the order of returns matters. With leverage, a bad sequence can force liquidation even if the long-term thesis is right. LTCM was not just a diversification failure. It was a leverage and liquidity failure. When spreads widened, margin calls hit. Margin is collateral required by lenders. The fund had to sell into illiquid markets. Liquidity risk showed up. Liquidity risk is the risk that you cannot exit at a fair price. Diversification cannot save you if you're forced to sell everything at the same time. A different kind of failure shows up in rogue trader stories. Nick Leeson at Barings is the classic. That was not about portfolio theory. It was about controls, incentives, and unchecked concentration. One person built a massive position, hid losses, and the bank collapsed. The lesson for diversification is simple. Institutions blow up when risk is allowed to concentrate in one place without transparency. In personal investing, the analog is the single trade that can ruin you. The one option strategy you do not fully understand. The one illiquid private deal. The one crypto exchange where all your assets sit. Diversification is also about diversifying counterparties. A counterparty is the entity on the other side of a trade or holding your assets. If the counterparty fails, your asset can become trapped or impaired. I also want to talk about time diversification, which people get wrong. Time diversification is the idea that holding longer reduces risk. Sometimes it does, but not always. Over long horizons, equities have historically beaten cash. That is a base rate. A base rate is what has happened on average across many periods. But the path can be brutal. Japan after 1989 is the reminder. Decades of sideways equity returns. If my plan depends on a specific decade working out, I am not diversified across time. I can diversify across time by staggering entry points, by keeping a cash buffer, by not forcing my future self to sell at the wrong moment. Behavioral finance sits under all of this. Loss aversion is the tendency to feel losses more than gains of the same size. Recency bias is the tendency to project the recent past into the future. Diversification helps because it reduces the emotional amplitude of the ride. But it can also hurt behavior if it becomes complexity. Too many holdings can make people reactive. They monitor more, they trade more, they chase performance. The best diversification is the kind you can actually hold. So what are the real benefits in plain terms? First, Diversification reduces the chance of a single point of failure. Second, it reduces volatility and drawdowns in many environments, which protects behavior and compounding. Third, it can improve risk-adjusted return. Risk-adjusted return means return per unit of risk, often measured by volatility or drawdown. Fourth, it protects against model error. Model error is being wrong about what drives returns. I might think a company is safe, then a new competitor shows up. I might think inflation is dead, then it comes back. Diversification admits that I can be wrong. Now the trade-offs. Diversification can dilute upside if I truly have edge in one area. Edge is a repeatable advantage, not a lucky streak. Diversification can also create a false sense of security. If I own 10 tech stocks, I am not diversified. I own one factor, growth and liquidity. A factor is a common driver of returns like value, momentum, size, or credit. In 2000, the dot-com crash punished that factor. In 2008, credit contagion punished many factors at once. Contagion is when stress spreads through the system and correlations spike. That is why I care about stress testing. Stress testing is imagining extreme scenarios and checking if the portfolio survives. I also keep an eye on convexity. Convexity is when the payoff accelerates in your favor as the move gets bigger, like owning options. Most portfolios are concave. Concave means losses accelerate faster than gains in stress, like leveraged carry trades. Many strategies that look diversified are actually the same short volatility trade. Short volatility means you earn small, steady gains most days, then you take a large loss when volatility spikes. Volatility spikes are common in crises. If I diversify across several short volatility strategies, I am not diversifying. I am stacking the same tail risk. The practical mindset I use is simple.